Imagine walking into a bank fully confident that you will get approved for a personal loan, only to be denied because of one tiny requirement almost everyone forgets. It feels frustrating, confusing, and even a little embarrassing. But here is the shocking part. Most people get denied not because they are unqualified, but because they miss small, simple rules that lenders never clearly explain. Today, you will learn exactly what those hidden personal loan requirements are and how to avoid the mistakes that cost many beginners their approval. And there is one requirement at the end that surprises almost everyone, so stay with me. Before we dive in, picture this. You need money fast, maybe for medical bills, car repairs, or debt consolidation. You click through a loan application feeling hopeful. You meet the income requirement, you have a fair credit score, you hit submit, then you wait. And suddenly, denial. No explanation, no tips, nothing. This video fixes that. You are about to learn how to put yourself in the strongest position possible before applying so you do not get blindsided again. Number 1. Understanding what lenders really look for. Lenders do not approve loans based on a single factor. They look at your entire financial picture. Think of it like a puzzle. If one piece is missing, the whole picture collapses. The main areas lenders check are credit score, income stability, debt-to-income ratio, banking history, and identity verification. For example, someone with a 680 credit score and steady job might still get denied if their debt-to-income ratio is too high. Another person with lower income might still get approved because they have almost no debt and a clean banking record. Understanding these pieces makes everything clearer. If you skip this big picture view, you may think you got denied for credit score when in reality it was something completely different. That's why we break each requirement down next. Number 2, the credit score minimum that most people get wrong. Many beginners think they need perfect credit to get a loan. That's not true. You do not need an 800 score. You don't even need a 700 score. In fact, many lenders approve borrowers starting around a 580 or 600 score. But here is the part most people miss. Lenders do not look only at the number, they look at the pattern.
They want to know if you are improving or declining. For example, someone with a 610 credit score that is trending upward can sometimes be seen as lower risk than someone with a 670 score that has 3 recent missed payments. Another hidden rule is recent credit activity. If you applied for 5 credit cards last month, your score may drop and lenders will see you as desperate for credit. That raises red flags. So the simple fix is this: check your score beforehand, avoid new applications for at least 60 days, and correct any errors. Even a small 30-point jump can be the difference between approval and denial. Number 3, the income requirement that is not as simple as it sounds. Many people believe there's a magical income number, like lenders require $50,000 a year. But the truth is very different. Lenders care more about income consistency than income size. For example, a person making $35,000 per year who has been at the same job for 3 years might be seen as more stable than someone making $60,000 but switching jobs every 3 months. Most lenders want at least 2 to 3 months of pay stubs or bank statements to prove regular income. And here's the big thing most people never hear. If your income changes a lot each month, lenders average it. That means a delivery driver making $2,000 one month, $3,000 the next month, and $1,500 the next month may get approved based on the average, not the highest number. So your goal is to show steady cash flow, not flashy numbers. Number 4, the debt-to-income ratio trap. Debt-to-income ratio is one of the biggest reasons for denial, and most beginners do not understand how it works. It's simply the percentage of your income that goes toward your monthly debt payments. If you make $3,000 a month and your monthly payments add up to $1,000, your debt-to-income ratio is about 33%. Many lenders want this number below 35 or 40%. Here's the trap. Even small monthly payments can push you over the limit. For example, a $20 streaming service does not matter, but a monthly payment of $90 for a small store credit card might be enough to get you denied.
Another example. Someone making $50,000 per year with $400 in monthly car payment, $150 in credit card payments, and $100 in personal loan payments may already be too close to the limit. The solution is simple. Pay off or reduce one or two small debts before applying. That little change often moves people from borderline to approved. Number 5. Your banking history matters more than you think. Most people never think about their bank account history when applying for a loan, but lenders quietly check something called your banking behavior. They look for overdrafts, negative balances, and bounced payments. If you have frequent overdrafts, lenders may see you as risky even if your credit score is fine. For example, imagine two people with the same score. One has no overdrafts in the past year. The other has 10 overdrafts in the past 3 months. The second person is far more likely to be denied. Some lenders even use tools like bank verification software that show your spending habits. They check if your paycheck hits your account regularly. They check if you consistently keep your balance above zero. A quick fix is to clean up your bank account for at least 60 days before applying. Avoid overdrafts, keep some money in your account, and make sure your pay deposits look steady. Number 6. Employment stability is more important than job title. Many beginners think that having a fancy job or a high-paying job is what matters, but employment stability is actually more important. If you have worked at the same job for a year or more, lenders trust you more. For example, someone earning $70,000 but switches jobs every 2 months might be seen as unstable. Meanwhile, someone earning $40,000 who has been at the same job for 14 months might be seen as reliable. Self-employed applicants face a similar rule. Lenders often require at least 1 or 2 years of business records, not just last month's income. So, if you are self-employed, gather tax returns, bank statements, and invoices before applying. Number 7. ID verification issues that cause instant denials. You can have good credit and solid income, but if your identity cannot be verified, the application ends immediately. Lenders check your social security number, your address history, and your identification documents. One common mistake beginners make is using an address that does not match their credit report. For example, if you recently moved and your credit report still shows your old address, the application may get flagged. Another issue is mismatched names. If your social security card shows your full name and your application uses a nickname or a shortened version, it may fail verification. Always check that your name, address, and identification match exactly across documents. This includes your driver's license, bank account, pay stubs, and credit report. Number 8. The hidden rule about checking accounts. Many people do not understand the difference between a soft pull and a hard pull. A soft pull checks your credit without affecting your score. A hard pull lowers your score slightly for a short period. Here is why this matters. Beginners often apply to multiple lenders at once without realizing they are stacking hard pulls. If you get 3 hard pulls in 1 week, lenders may see that as a sign of financial stress. For example, if you apply to 3 lenders for $3,000 each thinking you will choose the best one, all 3 will likely run a hard pull. Your score may drop 10 to 15 points quickly. The smarter approach is to use loan marketplaces that run 1 soft pull, then show you lenders you are pre-qualified for. This allows you to compare offers without damaging your score. Number 9. The proof of address matters more than people realize. Lenders need proof that you actually live where you say you live. This sounds simple, but it causes many denials. For example, using a friend's address or a temporary rental address may cause problems. Lenders often want documents like a utility bill, lease agreement, or bank statement that shows your name and address. A mismatch can cause an automatic stop. Before applying, gather 2 or 3 documents that match your current address exactly. Number 10. The hidden rule about checking accounts. Here is something almost no beginner knows. Many lenders require you to have an active checking account to receive the loan. Not having a checking account can automatically disqualify you, even if you meet every other requirement. For example, someone with stable income, great credit, and low debt might still be denied simply because they do not have a checking account where the lender can deposit the money and pull payments. If you do not have a checking account, open one at least 30 days before applying. This shows stability and gives lenders a clear place to send funds. Number 11, the mystery requirement most people never hear about. This is the requirement almost everyone misses. Lenders want to see that you can handle unexpected expenses. They look for something called discretionary income. This is the money left over after your bills are paid. For example, if you make $3,000 per month and your bills are roughly $2,200, you have $800 of discretionary income. That is a positive sign. But if you make $5,000 per month and your bills are $4,900, you technically earn more but have less wiggle room. Lenders may deny based on that. This rule explains why some high earners still get denied. Number 12, how to make yourself instantly more approve ready. Here are simple actions that dramatically increase approval odds. Clean your bank account for 60 days. Avoid overdrafts. Pay down one small debt. Avoid applying for new credit cards. Gather pay stubs, tax documents, and ID paperwork. Check your credit for errors and correct them. These steps make lenders see you as lower risk. Number 13, why loan amount matters more than you think. Many beginners apply for more money than they actually need, but the higher the loan amount, the stricter the requirements. For example, a lender may easily approve you for $2,000 but set stricter conditions for $10,000. Asking for a smaller amount first is often a smarter choice. Sometimes reducing your requested amount by just $500 is enough to turn a denial into an approval. Number 14, the requirement almost everyone misses until it is too late.
Lenders check for something called credit utilization. This is how much of your credit you currently use. If your credit card is maxed out, lenders see you as risky, even if you pay on time. For example, a person with a card limit of $2,000 and a balance of $1,900 looks risky, but lowering that balance to $800 or less before applying can make a huge difference. This is one of the easiest ways to improve your chances. Number 15, the hidden rule about recent large deposits. Lenders get nervous when they see large, unexplained deposits in your bank account right before you apply. Even if the money is legitimate, lenders worry it might be borrowed cash used to look financially stronger than you are. For example, if someone suddenly deposits $2,000 right before applying, the lender may ask for documentation. If you cannot explain where the money came from, your application may be denied. The solution is simple. Avoid big deposits 30 to 60 days before applying unless you have clear proof of where the money came from. Number 16, how your payment history predicts approval chances. Lenders do not just look at whether you have debt, they look at how you treat that debt. A single late payment from last month can hurt your chances more than a late payment from 2 years ago. For example, if you missed your car payment last month, a lender may hesitate because they fear you will miss your personal loan payment too. But if that late payment happened 3 years ago and your recent history is clean, you look much more reliable. This is why lenders pay extra attention to your last 6 to 12 months of payment behavior. Number 17, the type of debt you have can matter. Not all debt is seen the same way. Some debt is considered lower risk and some is higher risk. For instance, student loans and auto loans are usually seen as structured, predictable debts, but high credit card balances are seen as more dangerous because they indicate possible financial stress. So two people with the same amount of debt can have different approval odds. If most of your debt is from payday loans or high-interest credit cards, lenders may see more risk. Paying down those debts first can dramatically improve your approval chances. Number 18, the importance of having a backup contact.
Many lenders ask for a reference or a backup contact. This is not someone who pays your loan. It is simply someone who can confirm your identity if needed. A missing or invalid reference can slow down or even stop your approval. For example, if you list a reference who does not answer the phone or confirm your details, the lender may pause the application. Choose someone reliable with a stable phone number and let them know they might get a call. Number 19. The hidden rule about your savings buffer. Some lenders quietly check if you have any savings at all. They want to know that if something unexpected happens, you will still be able to pay the loan. Even having $300 to $500 saved can improve your application strength because it shows financial responsibility. For example, if two applicants have the same credit score and income, but one has a small savings cushion, lenders may lean toward approving the person with savings. Number 20. The way you use your bank account every month. Lenders often review your regular spending patterns. They look at how you handle your money from paycheck to paycheck. For example, if your account consistently drops to under $10 before payday, that signals financial stress. But if you maintain a small cushion between paychecks, even just $50 or $100, lenders see that as responsible behavior. This spending rhythm matters more than most beginners realize. Number 21. Consistency between applications and documents. Lenders compare what you write on your application with what appears on your documents. If there's even a small mismatch, it raises questions. For example, if your application says you make $3,000 per month, but your pay stubs show $2,800, that inconsistency can cause delays or denial. Always make sure your numbers match your proof exactly. Even rounding too much can create issues. Number 22. The timing of your application matters. Believe it or not, applying right after paying several large bills can sometimes help. Lenders analyze your current bank balance and recent activity. If your account looks clean, organized, and steady, you appear more reliable. For example, applying right after rent, utilities, and credit card payments are processed can make your bank statement appear clearer and more stable. Timing does not guarantee approval, but it can strengthen your profile. Number 23. The impact of having too many open accounts. Even if you pay everything on time, having too many open credit accounts can scare lenders. They worry you have access to more credit than you need and could suddenly accumulate debt. For example, someone with 9 active credit cards may look riskier than someone with 2 or 3 cards. Lenders love simplicity. If your credit profile looks cleaner and easier to understand, your approval odds often rise. Number 24. The lender's internal rules you never see. Every lender has its own secret checklist. Some lenders care more about employment length. Others care more about low debt levels. Some even specialize in borrowers with lower credit scores. This is why one lender may deny you, while another lender approves you for the exact same information. The key is not taking a denial personally. Sometimes it simply means you applied to the wrong lender. Shopping around with soft pull pre-qualification helps you find matches without hurting your score. Number 25. How your address history influences risk. If you move frequently, lenders may worry about instability. For example, someone who has changed addresses 4 times in 1 year may look less predictable than someone who has stayed at one address for 2 or 3 years. You do not need to own a home to look stable, but showing a consistent address for at least 12 months helps your financial profile appear stronger. Number 26. The hidden role of your monthly cash flow. Cash flow is the heartbeat of your finances. Lenders want to see that money flows into your account regularly and stays there long enough to cover bills. For example, someone who gets paid on Friday but spends almost everything by Monday looks riskier than someone whose money lasts throughout the week. Lenders check how long your balance stays positive. This small detail matters more than most people ever realize. Number 27. The requirement about public records. Lenders check for things like bankruptcies, foreclosures, and court judgments. Even if these happened years ago, they may still appear on your report. For example, a bankruptcy from 6 years ago might be old but still affects how lenders see you. The good news is that the farther away these events are, the less they matter. But you should know if anything is on your record before applying so you can prepare. Number 28. The rule about how you use your credit cards. Lenders notice behavior, not just numbers. If your credit report shows that you frequently max out your cards and then pay them off right before the statement date, lenders may consider this risky. It looks like you depend heavily on credit. Keeping your usage under 30% of your limit looks much healthier. For example, keeping a $600 balance on a $2,000 card appears much more stable than keeping a $1,900 balance. Number 30. The small details in your past borrowing history. Lenders study how you handled past loans, not just your current debt. For example, if you had a small personal loan 2 years ago and paid it off early, that is a great sign. But if you had a loan that went to collections 6 years ago, even after it is resolved, lenders may ask for more documents. Showing a positive history with borrowing makes lenders trust you more easily. Number 30. The rule about having a working phone number. This one surprises a lot of people. Lenders need to contact you. If your phone number is disconnected or constantly unreachable, your application might get delayed or denied. For example, if they try to send a verification code and your phone cannot receive it, the lender may stop the process. Make sure your phone works, can receive messages, and matches the number on your application.
You now understand the personal loan requirements most people miss. Some are simple, some are surprising, but when you prepare correctly, you give yourself a real chance to get approved without stress or confusion. Now I want to hear from you. Which requirements surprised you the most?